Good afternoon, girls. Today we will be discussing about the national income calculation by the income method. So before that, let me just tell you what is national income. Once again, national income is the value of the final goods and services produced by the normal resident of a country in a given period of 1 year. So how is national income calculated? So especially in income method, national income is calculated by adding up the factor incomes generated by all the producing units located within the domestic boundary plus net factor income from abroad during an accounting year. So income method is also known as, it is also called the factor payment method and distributed share method. So it is also known by two other names, that is factor payment method and distributed share method. So in this income method, there are some steps involved in calculating national income. So what are the steps involved in calculating national income? So we have three steps. Number one, identification and classification of producing enterprises. So what are the enterprises which are paying factor incomes to the factors involved in the process of production? So all those these enterprises belong to three sectors: primary sector, secondary sector, tertiary sector, that will be discussing vividly. And step number two, we have classification of the factor incomes. So factor incomes are found in four forms. Those are compensation to employees, in short COE. Then number two, we have operating surplus, we just say OA. Then mixed income represented by MI, and the last one, net factor income from abroad. We have been using this one. So operating surplus, in short, it is also known as OS. And the last and the final step is estimation of national income. In this final step, we will add up all the factor incomes of the producing enterprises. So national income is equal to COE, compensation of employees, then OS, operating surplus, MI, mixed income, and NFIA, that is net factor income from abroad. So national income is given by this formula. Next we'll be vividly discussing about the classification of the producing enterprises and the classification of factor income. So step by step. Now let us see the classification of the enterprises in different sectors. So all the producing enterprises can be classified under three heads. Those are primary sector, secondary sector, and tertiary sector. So this primary sector is that sector which produces goods by using natural resources like land, water, forest, mines, etc. So this sector includes, say, agriculture, livestock rearing, then quarrying, stone quarrying, then sand quarrying, etc. And mining is also included in this primary sector because it is just extracting the natural resources. Then secondary sector comprises all those enterprises which are involved in the transformation of one product to another, that is, transforming one commodity to another. For example, let us say weaving. In weaving, so yarns are converted into clothes. Tailoring, these clothes are converted into garments. And the confectionery, sweets, then bakery, etc. And shoe making, etc. also, from leather or from cloth, whatever, from rubber and all. Construction work of roads, then houses, bridge, market, hospital, these are all included in this secondary sector. Then what are the enterprises included in the tertiary sector? So enterprises producing services, only service, there is no production of physical goods. So example are banking, the work of the bankers, then transport and communication, then trade and commerce, then the profession of teaching, then medical profession of doctor, nurses, health workers. they all include under this tertiary sector. One more thing, not to be confused, motor car servicing, any vehicular servicing, then what's repairing come under this tertiary sector, because motor car servicing is not the making of motor car, it is just repairing. So there is no change in the commodity, only the servicing is done. Okay, then next we will see about the factor income in detail. Then let us see the compensation of employees. It can be just categorized into three heads. Number one, we have wages and salaries to be paid in cash, and number two, we have the compensation in kind, and number three, so we have employers' contribution to social security schemes. Okay, let us see one by one. So under this wages and salaries head, we have the basic pay. Total pay of an employee is composed of small components like basic pay, then dearness allowance, what we call DA, then house rent allowance, there is ISRA, then overtime allowances, then city compensatory allowance, we call CCA, then bonus and commissions, it is paid from time to time, and sick allowances are also given. If an employee is sick, then the employer is going to give say the money expenses for the treatment of that particular sick employee. Then compensation in kind, it comprises of free housing. Employer is giving free housing to the employee, then medical facilities, then free uniforms will be given to the employees, then free food, then free education, then convenience facilities, that is the transportation facilities, then creches for the children of the employees. Even there are section to look after the children of the working employees, so they will be looked after while their parents are working. So, and the value of the interest foregone on loans to the employees. Sometimes employee may give loans to the employees, but no interest or a very minimum interest are charged. So if that money is just lended to some other person, that employer would have collected a lot of interest, but that is not the case. Then the third one is employees' contribution to social security schemes, for example provident fund. So an employee can save some money in the form of the GPF or EPF, that is employees provident fund and all. So a particular employee will just save, for example, say rupees 500, then employer will just add one 500 more. In total, in his provident fund account there will be 1000 rupees, like that. So the employee is contributing. Then life insurance is also just done, then casualty insurance is also given, and pension on retirement. When an employee is retired, he'll get monthly pension. This very much pension is different from the old age pension. So in your locality you might have seen some widow or some old women, they are getting monthly pension, old age pension. It is very much different. It is not that old age pension is not included in calculation of national income, because that old age pension is very much different. It is transfer payment. That means those old aged persons, they are getting pension for not producing a good or services. It is just given by the government as a transfer payment. Then let us see the next factor income. So next component of our this compensation of the next component of the factor income is, after compensation employees, we have operating surplus. It consists of income from the property such as rent, then interest and royalty for not working by the person himself, but from his wealth. Then number two, we have in the operating surplus, number two, we have income from the entrepreneurship. that is nothing but profit. The entrepreneur will get profit for his management. So profit is equal to dividend plus corporation tax plus corporate savings. Corporate savings again are known by two other names, that is undistributed profits or the retained earnings. These three terms, corporate savings, then undistributed profit or retained earnings, are more or less the same thing. So profit is considered by dividend, corporation tax and retained earnings. Then the next component is mixed income. Mixed income is nothing but the mixed income of the self-employed persons. So the self-employed person will get payment in the form of wages, rent, interest and profit, because everything is owned and managed by the person himself. Then the last component of the factor income is nothing but the net factor income from abroad, and FIA. So how do we get the net factor income from abroad? So we get it, that is net factor income from abroad is equal to net compensation of the employees plus net property and entrepreneurship. That means we also get factor income from net property and entrepreneurship also in the form of profit or in the form of rent, interest and royalty from the foreign country. Then income from from the foreign country, then net retained earnings of the resident companies from abroad. So net retained earnings, it will be in the form of profit earned by a resident from the foreign countries, that we all know. So, and lastly we can express an FIA in the form of factor income from abroad by the normal resident minus factor income of the non-residents in the domestic territory. That is the income earned by our resident from the foreign country minus income earned by the foreigner in our country. That is the meaning. So we'll just see how the other aggregates of national income are related to the national income by the income method. So let us see next. So the last portion is estimation of national income by income method. So by adding up of the compensation of employees, operating surplus and mixed income of the self-employed, we get net domestic product at factor cost. If the net domestic product at factor cost is added by net factor income from abroad, if we add up net domestic product factor cost and net factor income from abroad, we get net national product at factor cost, which is also known as national income. If depreciation is added to the net national product at factor cost, we get GNPFC, that is gross national product at factor cost. If net indirect tax, NIT means net indirect tax, if net indirect tax is added to GNPFC, gross national product at factor cost, we get GNP market price. So this way, if we are given compensation employees at operating surplus and mixed income of the self-employed and the net factor income from abroad, we get the national income. If we get the national income or net national product factor cost, if depreciation given, then we can get gross national product at factor cost. If net indirect tax is given, we can again find out gross national product at market price. So next time we'll take up the precautions to be taken off while estimating the national income by income method. What are the exclusions and what are the inclusions? After that, we will just go to some numerical examples. Until then, stay tuned. Thank you. Bye bye for today.